We wrapped up the first half of the year with nearly 4% more home sales contracts than the first half of last year. While mortgage rates are worse than they were when we started 2026, they have been hovering in the mid sixes for a few months now and are still slightly below last year at this time. These are not what I'd call boom times for the housing market, but we have seen slow, consistent growth. Home prices finished the first half of the year basically flat with last year. The active market data, list prices and price per square foot, for example, are just below last year nationally, while the pending sales and the backward looking closed sales prices are just fractionally higher than a year ago. So while we can confidently say that home sales are up, the data shows that home prices are not. This pattern is precisely what we presented when we published our 2026 forecast and outlook report back in December. Home sales to slightly increase, home prices to be flat. So far this year, mortgage rates have averaged 6.4%, which is higher than most mortgage rate expectations were for 26 back then, but it's pretty close to exactly where we expected rates to be. One area where I missed in our forecast report is that we expected inventory to climb by another 10% in 2026, but that has not happened. The shortage crisis markets like Chicago and New York have seen little or no relief. That's a bit of a bummer. I wish I could say that there has been some relief for home buyers in these markets, but there really has been none. The shortage crisis continues there for sure. So, what's on tap for the second half of 2026? Based on where we see the data now, I have three expectations for the rest of 2026. I expect sales to stay slightly elevated over last year. This has been consistent. The conditions such as stock markets and employment numbers also seem to be supporting this expectation. We could see negative price headlines in the coming months, but I still expect the year to finish with very close to unchanged prices for the year. And third, inventory has been falling, but I don't think it falls further from here. Our current forecast models expect to finish the year with about 3% more homes on the market than in 2025. So while we're in short supply in some markets, nationally the market isn't going to shift to a new shortage crisis or anything like that. So I base these expectations on current data trends and an assumption that mortgage rates don't drive back up, say, to 7%. Maybe they even ease a bit lower from here. No one knows where rates are headed, of course, so that's an open factor for the rest of the year. Okay, let's dive into this week's data to see how the first half of 2026 finished up. Let's start with home sales. We counted 85,000 newly pending home sales this week across single family condos and townhomes. That's 5.9% ahead of the pace from the same week a year ago. So through the full month of June, the total was about 5% more sales than last year. And year to date, as I mentioned, the total count of home sales has been 3.9% more than in 2025. This growth is not a lot. It's not quite 100,000 more home sales so far now than last year, but it has been consistent. Each week, a few percent more sales than a year ago. If the pace continues, we'll end 2026 with 4.2 million existing home sales. I'm showing here the weekly count of the pending home sales. The blue line is this year. You can see the dip coming when we have the report next Monday. That period includes the 4th of July holiday. I hope you had a fabulous weekend with your family and friends. The chart here also illustrates the normal seasonal curve in the second half of the year. Notice how the gray line for 2022 started out strong and then collapsed in the second half of the year. So if we're lucky and the rest of the year, and there's no mortgage rate spike, maybe rates dip from here, then we could see in the coming months the most home sales going back all the way to 2021. The takeaway here is that home sales are growing slowly, which is pretty much exactly how we expected the year to behave. There's no big surge in sales. The affordability issue still looms too large, but each day that affordability factor improves, that means a few more sales can happen. So slow growth in home sales. Related to the growth in home sales is the fact that inventory has peaked and is no longer climbing. The total number of new listings each week is averaging only 1% more or so sellers than a year ago. Meanwhile, the sales are 5% higher. So also there are slightly more withdrawals this year. Withdrawn listings subtract from active inventory but aren't demand signals per se. And that leaves us with 1.09 million homes for sale around the country right now. That's 1.1% more than a week ago. And like I said, it's unchanged from last year at this time. In this chart, each line is a year. You can see the normal seasonal curve for inventory. And inventory has now reached its summer plateau. Through July, August, September, and actually into October, there will be roughly 1.1 million homes on the market at any given time. The absolute peak might not hit until October this year. Our current forecast models are now projecting October 23rd before this year's autumn correction really takes over, the contraction period really takes over. The summer plateau is very standard in the inventory data. Note, however, the 2024 line here in red. That year, inventory kept climbing through the summer months. There was no summer plateau. And that year was the worst of the interest rate challenges we've faced over the last few years. Rates climbed well over 7% for most of the year. And when rates rise, inventory rises. So the 2024 line here, the red line, is a clear illustration of that rule. When rates rise, inventory rises. This year, rates have stayed low enough to keep demand moving, but it's fragile. A bad set of inflation headlines could send the bond market reeling again and drive interest rates higher quickly. If mortgage rates head back to 7%, I would expect that we'd see a demand slowdown. We'd see inventory would have a late year surge. On the other hand, if we're lucky, and this year's trend continues, then rates maybe ease slightly lower from here. We could finish the year with fewer homes in inventory than last year. This is a surprise that I was definitely not expecting as we started 2026. Even as sales are slightly improved and inventory is no longer growing, the price pressures on homes continue to be more negative than positive. Today we're going to look at price reductions. So as of today, 39.5%, 39.5% of the homes on the market have taken a price cut from the original list price. These are homes that are on the market now. They haven't had an offer. They reduced their price. Maybe they get an offer in July to close in August or September. So the price cuts now give us insight into transactions for several months into the future. Measuring price reductions is actually pretty nuanced behavior. So in most MLSs, if you withdraw the listing and relist for 30 or 45 days later, you get to reset the original list price to a new original list price. And in the calculations we're showing here, we're actually counting the price reductions across delistings and relists. So most places you see price reduction data, it's probably undercounting the total because of the relist process. So by this measure, though, nearly 40% of the homes on the market have taken a price reduction. So in the annual chart here, you can see the normal seasonal curve where price reductions keep climbing until the holidays late in the year. Then the fresh new listings hit in the spring and the market resets. So the blue line is this year. There are fewer price cuts now than last year. The purple line is 2025. But the trajectory is just the same as it has been for the last few years. When home price changes are coming soon, you see the change in this trajectory first. When the market is cooling, price reductions are climbing. When the market is heating up, price reduction trajectory slopes lower. So for example, you can see the surprising demand in the yellow 2023 line. The market needed fewer price reductions later in the spring that year. But the rug got pulled on demand late 2023. At the right end of the chart, you can see those price cuts climbed again. So this data is really clear illustration of the ebbs and flows of housing demand. So this year, 2026 started with better demand and fewer price reductions. You can see that in the blue line at the left end of the chart for January. That momentum slowed when the war started and rates shot higher. The lesson from the price reductions data today is that home sales nationally don't have enough demand to change the course of prices currently. Nearly 40% of the homes on the market With price cuts, that's pretty big. That slope isn't increasing, though. So if you have a significantly bearish hypothesis for home prices, that's not in the data either. And that's why my expectation for the second half of the year is that we're still at this roughly no home price appreciation for 26 over 25. So let's close today with price per square foot. I like using this measure of prices because it normalizes the data across different sizes and types of homes. The asking price per square foot around the country right now is 2% below last year at this time. So currently just over $217 per foot is in fact below the price point of 2 years ago. There are a lot of measures on home prices that show basically no appreciation for several years on average nationally. Some markets, of course, are up and some are down, but this chart helps us see that normal seasonal pattern in home prices. Price decline in the second half of the year. That inflection point has already happened this year. The seasonal strength, happens with pricing happens because the best properties meet the most demand in Q2. Now we're in Q3, and the window to sell starts to shorten up during those summer months, so homes get a little discount. Now, not all price measures of prices are below last year. The median price of the pending sales, those homes that are going into contract each week, is now about $402,000. That's 0.5% above last year. The Case-Shiller Index, which is based on measures of the price of sales on the same house over time, for April was released last week, and that's still 0.7% above 2025. So by all those measures, even if they're positive, are very close to unchanged for the year. The markets where home prices are higher are mostly in the Midwest and Northeast. These markets have had very tight inventory, so the demand is still pressured. We've talked a lot about those markets recently, and that dynamic is still underway. Okay, that's all the data we have time for this week. My takeaways for the second half of 2026 are number one, home sales stay slightly above the 2025 levels. Number two, home prices have negative pressure, but they finish the year flat with 2025. And number three, inventory, which has recently fallen below last year, does not keep falling from here and finishes up maybe 3% over last year. Supply doesn't keep shrinking. At least that's the current expectations. All right, more next week. Thanks, everybody.